fundamental to what we do. It's in our DNA. Every day, FTSE calculates around 150,000 unique indices. If you look at all the variants of those indices, then it's probably around 1 million in total. 1,200 of those indices we calculate in real time, with more than 140 on what we call a streaming tick-by-tick basis. And we calculate domestic benchmarks for exchanges in the UK, South Africa, Italy, Singapore, Malaysia and Taiwan. And every day we also produce thousands of custom indices for our institutional clients. And what I would emphasize that whilst much of the focus in the ETF space remains on well-diversified, what I might call standard benchmarks, amongst our institutional clients we're seeing a growing trend for customized index solutions for performance measurement, benchmarking and so on. It's also worth noting that we've got a research team of more than 80 people across the world now who are focused solely on delivering world-class innovative investment solutions. If I can move on to the third slide. So I don't want to spend too long on this slide, but I simply want to emphasize we do have relationships with more than 40 ETF issuers globally. Alongside Vanguard, we have a long-established relationship with BlackRock, but also with PowerShares and Schwab, amongst others. And of course, on China-themed ETFs, we have a leading position globally. So we can just turn to my final slide before handing over to Jamie. So all financial institutions, as Joel was saying, including Vanguard, insist on high quality, transparent and reliable benchmarks from their index providers. All of the leading index providers globally deliver high quality indices. I believe ours are the best, but the majority of differences that do exist between index providers reflect policy choices. Now, governance would be an example of that. But there are others listed here. So our index methodology is strictly rules-based. We rely on committees of seasoned and very experienced industry practitioners from many of the world's leading financial institutions to advise and inform our decisions. Jamie will talk more about our governance structure in a moment. But perhaps I could just take this opportunity to thank all of our committee members globally from around the world for their work and their efforts. And they ensure our indices reflect the market, remain objective and represent the needs of our clients and indeed our clients' clients. The reality is that the complexity of today's markets and the evolving needs of our investors drive everything that we do. We have an immensely strong focus on governance now. We take all of our responsibilities, and particularly our responsibilities in relation to country classification, immensely seriously. So Jamie will talk more about this, but just let me put this out there. Our country classification committee and we believe Korea is a developed market. It's an OECD member, it's the world's 12th largest economy, it's Asia's 4th largest economy, it's the world's 7th largest exporter. If you go there, it feels like a developed market. And like all of our country classification decisions, that view was based on transparent, published methodology, engagement with the country and some very detailed analysis. So we would argue that investors don't want to buy a developed market when they choose an emerging market fund. They want to buy China, Brazil and India and so on. I suppose on this basis we feel that those countries are seriously underweighted in an index that includes Korea. But this is an important point. I talked earlier about the large number of custom indices we create for our clients. We have no issue creating customized indices for clients who take a different view about the status of any market, including Korea. And that's perhaps a good example of our flexibility. We like to pride ourselves on being a flexible business, and I mean that in all senses. We're always looking to respond to the needs of our clients and to changes in the market. We want to make sure we deliver products and services which meet the needs of our clients, both in the standard indices and in the customized versions that we create and deliver. I think we're trying to talk the language of our clients. I hope Joel will agree that we did that in our discussions with Vanguard. I think just the final point I'd make is that we do put what I describe as careful, thoughtful, analysis-driven innovation at the heart of everything we do. We've partnered with world-class, leading financial institutions, industry trade bodies, exchanges, those with world-leading intellectual capital, some of the world's most respected financial academics and thinkers, and it's those partnerships that have allowed us to create what I would call an innovation engine. And that innovation engine is an important part of what will drive growth in the ETF market. It's true today that we've got market-leading positions in China-themed benchmarks, in real estate through our partnership with ETNA and REIT, and of course in the non-market cap weighted index space through a variety of partnerships, including that with research affiliates. With many other important partnerships, but I know what you want to do now is hear more about our methodologies and approach. So perhaps I can hand over to Jamie Perrett.
Thank you, Jonathan, and good afternoon, everyone. And Jonathan's sort of, given us a, very good sort of overview of FTSE itself. And what I'm going to do is just go into a little bit more detail and talk about some of the kind of key aspects that sort of Jonathan has been speaking. I think one of the sort of key areas is our committee structure, and it's really at the heart of how FTSE governs its indices. Independent committees are made up of leading investment market professionals from around the world. And the committees ensure that indices are managed and calculated in accordance to a transparent set of index rules. These index rules are available on our website. And literally, we have our client services team providing sort of support to our clients on any questions that they may have. I mean, the committees also ensure that the indices continue to meet the market needs and advise on the design and the creation of new indices. Hopefully people can see the sort of the presentation in front. And what we can sort of see here is sort of an outline of the structure of our committees. And underneath the FTSE Policy Group, which I'll just talk about in a little bit, we can sort of see that there's a lot of different specific expertise in particular areas, and I can't sort of understate the value and worth that these individual committees have, be it on the country classification, the nationality committee, which looks actually where a company should be based and in which country, and looking at the regional equity committees, and they kind of govern each of the regions. So if we take Americas, for example, that's made up of regional expertise from fund managers, custodians, plan sponsors, and brokers and sort of corporate advisors. Now, all of these sort of committees, will provide sort of their input, and they'll make recommendations to the FTSE Policy Group, and this sort of policy group sort of oversees the committees itself, and members are typically sort of CIO level or equivalent. Now, just sort of moving over to the country classification. Now, FTSE implemented in 2004 our country classification approach, and it was created to provide a transparent way for investors to gauge the likelihood of countries moving between developed and emerging categories. I mean, at the time, there wasn't anything really in place by index providers, even FTSE, to kind of give an indication to our users on, where countries actually lay, especially when, investors are looking to diversify their holdings overseas. Now, as well as considering sort of a country's GDP per capita income, which is generally how people, using the World Bank's definition, sort of see a particular market. FTSE also uses like 21 quality of market criteria. And these look at particular areas such as the quality of regulation in place in that particular market, custody and settlement procedures, the dealing landscape, and presence of sort of derivative markets. Now, all this sort of areas is taken into account by engaging with the regulatory authorities, and we sort of send over questionnaires, and each item under those 21 quality of market criteria will literally have a series of sort of questions relating to them, and that's then brought into the committee along with discussions with the stock exchanges and international investors in order to give them an informed opinion of how that country should actually sort of sit within FTSE's indices. along with looking at the material size of countries, and that forms the basis of how our country classification committee and sort of make their recommendations to our policy group. Now, this approach happens every year. The announcement is normally in September, but also what we do is we provide what we call a watch list. So these are countries that potentially could be promoted from one area, say from emerging to advanced emerging, or from advanced emerging to developed. And likewise, any countries that potentially could be demoted. And we update the information in our quality sort of market matrix on a semi-annual basis. So there'll be an update, for example, this coming March, and then any announcements of changes will be the coming September. I think that you can sort of see at the bottom left-hand side sort of a table. And I just wanted to kind of outline that, index providers, they have sort of similar criteria in order to determine whether or not a country is developed. At the end of the day, or emerging, but at the end of the day, it's literally how those criteria are actually sort of applied, and there's a lot of complexity, and there are different approaches of how this is sort of dealt with, and FTSE feels that with its committee type approach that it kind of gets to what our clients want. So just looking at here, you can see that maybe the sort of FTSE led in the field of index providers for say Israel, but then again there are other areas where that's we haven't sort of moved as quickly as other index providers for particular markets. Israel, you can sort of see here that most index providers will rate Israel as developed, and FTSE did that in September 2008. Others did that from the beginning of 2001. Likewise, Korea is developed by, say, FTSE, but you can see that some are by emerging and others actually will call that developed. Interestingly, Iceland isn't part of FTSE's indices, but you can sort of see that, again, how the classification works. Iceland has been demoted from the particular area. So that's kind of how our country classification sort of approach works. And the whole concept behind here is transparency, giving sufficient notice to investors and users of our indices in order for them to sort of make an informed sort of approach on any changes that take place. Now, our global equity index series obviously is sort of the key index that FTSE has, along with obviously other indices that we have with our partners and non-equity based products. And our global equity index series was launched back in 2003 to provide a seamless and non-overlapping sort of building block approach between large, mid and small cap companies in both developed and emerging markets. And interestingly, at that time, there was only a limited number of index providers that actually provided this sort of building block approach. So indices have evolved quite some way and will continue to do so. And FTSE calculated indices before then, so don't think that we haven't had indices. We have our FTSE or World Index, for example, has a sort of structure going back to sort of 1986. So there are sort of quite a bit of sort of track records for FTSE's global indices. And our global equity index series aims to capture 98% of the investable opportunity set, and that's in sort of 47 countries, and it captures over 7,000 companies on a global basis. Now, our indices are actually reviewed on an annual basis, and they're actually broken down into 7 regions, with the exception of Japan. And the whole concept of that is that we've actually aligned the way our indices work with how most institutional investors run their mandates. And what we're trying to say here is that most investors will look to invest on, say, an Asia-Pacific ex-Japan basis. So, the structure of our indices sort of takes that into account. It's interesting, just comparing how other index providers will sort of look at this. And one of the areas, I've been in the index business for over 12 years and sort of seen how indices have evolved. And, one side doesn't sort of fit all here. There is choice. So, for example, there are other index providers that will capture 98%. Others will say capture 99, and some will literally just have a cutoff, a market cap cutoff, as a basis for inclusion in their indices. Some will actually review on a country and a regional basis, similar to FTSE. Others will actually look at countries on their own and take the sort of representation from there, and others will actually look at the global universe and apply their particular sort of market cap cuts. So it does vary. Now, when undertaking the review process, there are a series of screens that are applied at each of FTSE's sort of regional universes. And I'm just going to kind of walk you sort of through a few of these just to kind of give you an understanding of sort of some of the approaches that we take. Now, for example, for size, what we do is we apply size rules across regions on a cumulative and a relative basis. And what we're trying to do here is have consistency in size integrity for our indices. What does that mean? Well, we'll rank all of the companies price times shares. And why price times shares? Because that's kind of giving you a good indication of the size of the company if you use, say, free float adjusted market cap, which is price times free float times shares. What you might see is that a company that is very, very large with only a small amount of free float could potentially be classified as a large cap company. And most index providers have sort of, over the years, have sort of changed that approach and use a price times shares component. So we rank all of the companies within a region by price times shares, and then we take a cut at 98%, and that gives us our review universe. And then we literally break down that review universe by, as you can see in the bottom left-hand side, 70% of that regional universe is going to be what we call large cap, the next 20% is mid cap, and the next 10% is small cap. And we apply buffers as part of those cut-offs to reduce turnover and to avoid any sort of unnecessary noise as part of the review process. Interestingly, some index providers will have small cap as 10%, others will have it at, say, 15%. Some will have large cap, same as FTSE, at 70%. Some will have it at 60%. So it does vary on sort of the cut-offs that you see. So not only the review process, but also the cut-offs can be different. Obviously, from a global perspective, you would expect the performances to be very, very similar. Similar for large cap, you would expect them, and most probably large and mid, because of the fact that the large cap companies are driving that. But you're going to get sort of some differences in performance between the sort of the mid and small cap because of that sort of difference in cut-offs. Just as an example, our FTSE Emerging Index is made up of large and mid-cap companies and presents around about 90% of each regional universe, and that's around about 800 companies. If I go over to the right-hand side, you can see what it says, FTSE All World, which the Emerging Index is made up of, and that's sort of adding developed and emerging sort of large and mid-cap companies, and that gives you around about 2,800 companies as part of our index universe. Now, we also apply additional screens on top of just size. So, for example, we look for free float. So we're actually looking at companies that have sufficient available number of shares for trading. And those that don't have a sufficient number, then we exclude those companies. Now, currently, our companies in FTSE's indices are weighted on a banded free float basis. But that banding free float is actually going to change in March 2013. We're actually going to be calculating actual free float. And what that actually means is that rather than, say, banding a company at 40%, we're going to weight them by the actual free float that they have as reported, so maybe 36%. And you might think, well, 36%, so what? But, what it's doing is, A, including the accuracy of the index calculation, but also when it comes to corporate actions and, the shares in issue might change, but the banding process potentially doesn't, that will impact and cause potential turnover depending on the particular corporate event. Other index providers also have banding approach, so it'd be interesting to sort of see, FTSE sort of within sort of, or started to free float adjust its sort of indices, in the early 2000s. So it'd be interesting to sort of see if people start moving over to the banding sort of or non-banding side and moving to actual in the future. And partly the reason why we've done that also is that information is becoming a lot more efficient in the markets. We can on a global basis that we feel that we can have more accurate information for our clients. Liquidity again is a very important process. At each review, companies are tested for liquidity, and we apply a median liquidity screen over a 12 month time horizon. So we're actually looking each month at the daily trading in order to sort of ensure that the indices are sufficiently liquid. And we have a more stringent requirement for companies that are going into the index compared to companies that are already in the index. So there is that sort of larger hurdle once included. I think the other kind of key point is the fact that we also adjust for seasonality. As you know, markets are on holiday over a particular time. You know, people have summer holidays, etc. So we do adjust for that. But the other key component is that we don't differentiate between developed or emerging markets, and likewise between large or small cap companies. We see that you're either sufficiently liquid or you're not the fact that you're sort of in an emerging market index. One other complex area, or I like to deem it complex, is our nationality screens. And FTSE actually has a nationality committee, and this committee, similar to the other committees that have, are made up of market practitioners who have expertise in this area. And what they do is will assign a company to a single country by guidelines that are included in our index rules. It is quite complicated. There are instances that, it can be quite difficult, but I think what the key thing is that we try to include companies depending on where they fit in those guidelines. And if they don't, for example, because of the fact that we'll exclude them for size or liquidity, but we will generally try to keep companies in our indices. And I think that's important in a market environment where companies listed outside of their home market to gain capital. It's a nationality committee that we use to ensure the index rules and approach to where the companies fit within FTSE's indices sort of meets the market's requirements. And this is especially true for what they call orphan stocks. So, the Pradas of this world, where they've literally tried to gain capital outside of Italy, and they've listed in Hong Kong. And, it's a nationality sort of committee to decide, whether or not these companies should be included in the benchmark, which we think they do because it's the opportunity set for investors or not. Some index providers will include companies such as Prada, and others won't. Likewise, in other markets, they will be excluded. And some of them can be quite large. And so that sort of gives you an overview of sort of how our sort of index sort of methodology works. One of the things for me that, over the sort of the years that I've been in the index business is that, indices have continued to evolve, especially as, the markets and the investor preferences change. And just sort of kind of going through that, I just wanted to kind of highlight some of the areas that the sort of, FTSE's been involved in, and there are more, we've looked at, FTSE in 2005 sort of launched sort of the first non-market cap weighted indices with our partners. But, FTSE was, pivotal in changing sort of, or being the pioneer for implementing free floats on a global basis with our indices back in 2001. We expanded our global equity universe to include, seamless coverage for emerging and small cap companies back in 2003. You can see here that, we calculate disseminated indices on a stream basis, and what that literally means is that, obviously technology is improving. Our clients are telling us we want to have indices that are disseminated not on a every 15-second basis, but an intra-second basis. So, again, we're trying to provide that level of support and quality that our clients and service that our clients are expecting. And likewise, in 2012, we announced sort of a new range of independently calculated, executable spot FX benchmarks. And I think the key thing for me, and just sort of rounding up, is this is not the end of the story, but actually it's just the beginning, and which is why it makes, I think, me and honestly IndexUniverse and all of you sort of listening, sort of excited about sort of the way that the index industry is going. So if I pass it back over, and we can sort of just continue our discussion. So if I pass it over to Joel.
Yeah, actually, Jamie, why don't you just advance the slide if you could? And
yeah, sure.
So one of the things, and obviously a lot of the discussion about the benchmark change that has come up, obviously it's a big piece of it, is the transition of Korea out of the emerging markets index and into developed markets. And one of the things that we were able to do to enable this transition to be done in what we hope will be a relatively seamless and very cost-effective way is working with FTSE to be able to control this transition, and really the construction of a transition index that FTSE is going to be doing for this piece of the Korea move out of emerging markets will help us minimize transaction costs. As we've stated, we don't expect any tax impact in terms of a capital gain realization at this point in time from the movement of Korea. But what this transition index allows us to do is, over the course of about a 25-week horizon, have a transparent way of demonstrating how we are transitioning from the old index to the new FTSE Emerging Markets Index, and incorporating a number of the index construction differences that FTSE has. And Jamie, you can certainly talk to this a little bit more, but we did just want to highlight that by being able to do this in an orderly way, where we could control the transition and the transaction costs associated with us, to us was an important piece of the relationship that we have built with FTSE on this front.
No, thank you, Joel. And if I say we just go back to that transition sort of slide, I think Joel's right, and I think the key thing for FTSE is that what we wanted to do is design and sort of calculate a way of sort of helping our clients, including Vanguard, to transition and manage any transition over a period of time. And you can sort of see the building block approaches here, because at the moment our FTSE Emerging Index doesn't include Korea. But obviously, from a transition perspective, Korea is part of the underlying index. So what we were doing is not only taking into account Korea, and I think that Joel has pointed out, we will actually transition that. So on a week-by-week basis, the weight of Korean companies will go down, and we've been very careful in sort of selecting. So if there's a corporate action, for example, we ensure that the weight of the Korea index doesn't go up, literally because of the fact that it will be going down in the following week. The other aspects are the fact that as part of FTSE's process, P-ships, for example, which are sort of private Chinese companies that are listed in Hong Kong, they're going to be added to our emerging index in March 2013, and we wanted to sort of ensure that those were included. But also, I think I mentioned about we're going to move to actual free float in 2013 as well. So to avoid any unnecessary turnover for our clients, we kind of put this sort of building block approach to create the emerging transition index. Now, the rules are published online on FTSE's website, along with further information about the transition indices. And the whole point is to be as transparent as possible for our clients. I think that's it from me. And maybe if I just pass over to Jonathan.
Yeah, okay. Well, thanks, Jeremy, and thanks, Joel. So just to sum up very, very briefly, I mean, Joel talked a little bit about Vanguard's decision and the background to why they were switching benchmarks on 170 billion of assets. Jamie's talked about our index methodologies, and I talked a little bit about FTSE as a company. I think it's an immensely exciting time for everyone involved in the index industry. And I'd just close and say that this is really is a story that is all about benchmark choice, and hopefully that's something we'll pick up in the questions which follow. But can I pass it back to you, Matt, to moderate that?
Yeah, great, Jonathan. Thank you so much, and thanks to Jamie and Joel as well. That was a great introduction to FTSE and what you guys are doing. Joel, we have a lot of questions from the audience, and Jonathan and Jamie too. I'd remind the audience you can continue to file questions with us using the Q&A tool at the bottom of your screen. But I'll start from big picture and then narrow down. Joel, there is this, you addressed, sort of the cost, long-term cost certainty and cost savings. One two-part question we got from the audience is there any short-term, cost that could hurt investors for making this transition? And two, it's a pretty bold move to change benchmarks on, one of the fastest-growing ETFs in the world. So address again just quickly what motivated you to make that decision.
Sure. So In terms of short-term costs, will there be some transaction costs in transitioning from from the current index to the new index? Sure. I mean, there are some differences, and that will lead to some transaction costs during the transition. Although I would say and characterize it that in most of these cases, we're talking about a transition that's really not that different than a regular index reconstitution that would occur through the normal course of even any one particular index provider's evolution over time as companies and market caps and so forth get rebalanced over the course of a year, for example. But certainly there are some transaction costs that will be incurred, and that was one of the main reasons that we worked with FTSE to create, in the case of the Emerging Markets Fund, this transition index to be able to manage that process more under our own control, without it being sort of forced on us by external forces into having to make a big transition when maybe others might be doing that at the same time, which could then actually increase the transaction costs. And honestly, from our standpoint, as we look at, for example, the Korea issue within emerging markets, from Vanguard's perspective, while as Jamie pointed out, there's currently some difference of opinion between developed and emerging by some of the index providers, we think it's a matter of when, not if, Korea moves to developed across the board. And so, it's a question then of when do you want to incur these transaction costs. And again, we felt it was most beneficial for our investors, given that we were making this benchmark switch, to be able to do that in a controlled, orderly way under more of our terms to minimize those costs for investors. In terms of a bold move, if you will, in terms of transitioning the index, well, from our standpoint, as I said, it was really about an evaluation of being able to maintain a high-quality benchmark index to allow our investors exposure to emerging markets equities, and to do so in a long-term, cost-effective, and cost-controlled way.
Yeah, and I have a lot of questions from the audience around the Korea move in particular, but I wanted to ask FTSE sort of one broad-based question. I mean, from your perspective, Jonathan, so what does this mean, not just for FTSE, you addressed that, but for sort of the entire index industry, and how do you see sort of that market evolving in the near term? Is this a sort of seminal moment?
So I think certainly this is for us is a transformational deal. As I was saying earlier, it does lift our visibility here in the United States, but frankly to the levels that we enjoy elsewhere in the world anyway. It lifts our position in the ETF market. So those things are, if you like, important for us. But more broadly for the ETF marketplace, for issuers and for investors and advisors, I think this is simply a story about choice. And I think competition, in any market is good. We've been a strong competitor consistently across the world with the other index providers. We intend to continue to compete very hard for business going forward, and I think that choice is a good thing for everyone, frankly. So I think longer term, Matt, I think this will be seen as a positive step for the industry. I think it'll be seen as a positive step for issuers, and I think it'll be seen as a positive step for end clients.
Right. I guess let's dig into the Korea questions, right? The obvious, that's the biggest difference that a lot of people seized on. And this is probably a question for Jamie. What do you think about the concerns other index providers have around currency controls or other aspects of the Korean market that keep it in the emerging camp? Do you agree that it's a matter of time and you're just ahead of the curve? Do you worry about that currency conversion issue? What are your thoughts there?
It is a very interesting sort of area, because I think that yes, there are particular areas that increase operational sort of cost for investing into Korea. But I think the key thing is that people are investing in Korea. I think I might throw this over to Joel as well, but it's been part of investment portfolios globally. If you look at liquidity, look at the size of the market. Even if you look on a global basis, this is a big market, and even if you don't think it's sort of developed now, which FTSE does, I mean, these things sort of transpire, and there has to be a cut-off point between when you feel that you're not distorting an existing index, i.e., I think Korea weight would be around about 15% in an emerging market index. So there has to be a point, and I think over the years, Korea has been part of our sort of watch list from going from emerging to sort of developed, and I think that the committee sort of made the decide literally because of the fact that we've been working with the exchange. They've improved particular areas, and we were looking at they provided sort of facility to sort of trade foreigners to trade, and again there are particular areas that still need to improve. But I think that the sort of the nationality or the country classification committee decided that yes, from their perspective, that Korea should become a developed market, and that's what took place in 2009. And I think the other area I'd just like to sort of say is that we gave the market advance notification. So it's one thing making the change, but again, it's making sure that our clients are comfortable, will also have sufficient information to do that. And likewise, we're doing with Vanguard and other clients are sort of making any sort of changes and moves over.
And Jamie, what's on the bubble? Yeah, go ahead, Joel.
Matt, I was just going to add, and again, I'll put the hat on from sort of Vanguard as an institutional investor perspective for a moment, and we have over $10 billion invested in Korean equities across our firm, and so if you sort of look at three broad categories of criteria, you think about sort of the economic development or size of the market, the liquidity and size of the capital markets, and then how accessible that market is. I mean, you're really talking about some of the concerns that are expressed are not really about the first two. It's about how easily or how effectively you can access the Korean equity market. And like I said, we have over $10 billion in Korean equities, and we feel we can access that market in a way that can benefit investors, and that we can do so in a very effective way. Would we like to have in-kind transactions available in Korea? Sure. Would we like a little bit better currency convertibility? Sure. It makes the job a little bit easier, but on balance, we are able to invest in Korea in a way that we believe does allow it to be a developed market.
Right.
I'd just like to point to one other thing, Matt. And again, I'm sort of looping it the other way around. I mean, if you take an existing country, a developed country, so, we know that sort of particular countries have been sort of fighting the way sort of interest rate differentials and working. So Switzerland of this world, Australia. I mean, if they applied an FX sort of adopting an FX position, similar to what Korea have, would that make them an emerging market? I mean that's the other way sort of looking at it. I personally don't think it would, but I just thought I'd just sort of throw that out there.
Sure, absolutely. And Jamie, what other countries are on the bubble right now? We hear a lot of questions about Taiwan's status from the audience, and Greece going the other direction. Maybe you can comment briefly on those.
Yeah, no, that's very important. I mean, I think for Taiwan, again, it has similar characteristics to, say, Korea with regards to the sort of the FX side. But, its market is smaller. There's still issues with regards to settlement. So I think settlement is in kind still. I think it's like a T+1. It works out around about 2 plus 1.5, but it still causes additional complexity. But also, this is a dynamic market as well, and there's been sort of announcements on capital gains tax implications for domestic, but also international investors. So there's areas that the sort of committee still needs to weigh up. So they don't take these things lightly. These things sort of happen over time, and obviously when the timing is right, and our clients in the committee feel that it makes sense intends to sort of transition Taiwan over to development, they will do so. With regards to Greece, I think the key thing from FTSE's perspective and our committees is that, I think it's kind of like we're waiting. I mean, Greece has been part of our sort of watch list indices, the demotion to like advanced emerging, for a couple of years. But I think the key thing is, people saying what happens if Greece goes out of the Eurozone, etc. And I think that the key thing is that depending on the circumstances, obviously have implications on how it will affect our clients. And FTSE's, very, very careful along with our committees to ensure that we have all the evidence in place before making any decisions on what to do with Greece. And I think that most index providers have sort of responded likewise.
Sure. Yeah. Good answer. Joel, I have a question from the audience. That I've gotten asked a lot. Regardless of whether they individually believe Korea is developed or emerging, a lot of institutional investors are benchmarked to MSCI. So the question is, what are the benefits that they get that offset that tracking error? And then to FTSE, do we see more institutional investors moving over into FTSE benchmarking, particularly in the international markets?
Yeah, so, I mean, if we think about this from how investors usually build exposures, you're talking about getting exposure to broad international equities. And if you look at a broad, say, FTSE global equity benchmark or another provider's broad international benchmark, they are very, very similar to each other in the same way that many domestic U.S. stock indices that are broad, that include all sectors and all market cap and all styles, also reflect very similar risk exposures. So a lot of times the question about a particular benchmarking of an institutional investor often comes down to slices of that overall international equity exposure, and whether they're looking at each individual slice relative to a particular benchmark, or looking at or sort of thinking about the whole international equity portfolio. And I guess what I would say is from an entire international equity portfolio and providing exposure, there's not a lot of difference between the benchmarks and not a lot of tracking error generally. When you get down into individual exposures, you might see some more. I guess the question there is it really on a product-by-product basis that you're evaluating yourself, or is it sort of just one part of the overall total that you need to be focused on? And even if it is, on a piece-by-piece basis, it's been interesting to me to hear some of the, I guess I would call, knee-jerk reactions in some ways in terms of how to deal with the potential transition. So, for example, let's say take Korea out of emerging markets. I mean, is really the whole idea to sell an entire emerging markets portfolio, potentially realizing a tax implication and potentially having higher expenses on the entire portfolio to just deal with a small subset of the portfolio, namely about 15% under the current index? I think there are other ways that investors could, if they are concerned about that issue, I think there are other ways that investors can do it without having to realize taxes on the full amount of the investment, or with potentially increasing the costs on the full amount of their investment.
Yeah, that's a great question.
And just from the, more broadly, I think, Matt, you were just asking about kind of institutional investors. I mean, obviously, as I said right at the start, very many institutional investors across the world already use FTSE benchmarks. We're very well established. Here in the US, I would just use that word choice again. We recognize that we are number 2 in the international equities space in the US marketplace. And I think that simply means that we have to work harder, with our clients and prospects. I personally, I think being number 2 in the market is a great place to be, because I think you have to work extremely hard to get to number 1. That's what we're doing here in the United States. We're working with clients and prospects. I'm sure it won't surprise anyone on this call to know that, as a consequence of the Vanguard decision, we've had a accelerated level of interest in those who are looking at our benchmarks, and we're delighted about that. But it comes back to a story about choice. Our job is to get out to clients and our prospects and intermediaries globally to tell them the FTSE story, to let them have a look at our products and our services, understand how we go about creating indices and methodologies, and then let them make a decision about their benchmark. But that's our business, and that's what we're focused on.
Great. I have one specific question for Jamie that focuses around China, which is definitely an area where FTSE has been number one in the ETF market, at least, if not globally. It's a two-part question, Jamie. One, the most popular China ETF out there is tied to the FTSE Xinhua 25 index, and so the question there is, do investors need a broader benchmark for their Chinese exposure? And the second piece of the question was, maybe could you shed some light on the decision to add P chips into the index, the emerging markets index, and why they weren't there initially?
No, I mean, that's some good questions. Interestingly, the FTSE China 25 index was one of the first indices that I worked on at FTSE many moons ago. So it's been quite good for me to sort of see how that index has evolved over time. And I think the key thing is evolution. Interestingly, what the index is trying to do is capture sort of the mega cap companies, Chinese companies that are listed on Hong Kong. And even though there's only 25 companies, the representation is actually still quite strong, largely because of the fact that there is that skew to sort of big Chinese sort of companies listed in Hong Kong. I think you sort of mentioned P chips. I think that we've already made the announcement that sort of P chips will be included in the sort of China 25 index, and I think that this has sort of been discussed at the committee over the years. I think that just sort of as a background for everyone, P chips are literally companies that are listed in Hong Kong. They're incorporated outside of mainland China, but they have some form of business exposure or some sort of tradition being based in mainland China. And generally there's lots of these sort of P chip companies, but actually they're relatively sort of small. There's only a small number of sort of reasonably large companies in there. Making that sort of change, I think that over time, more interest is come to sort of capture Chinese companies, and the committee sort of decided to literally allow those companies to sort of move into China rather than being Hong Kong. I mean, I've been based in Hong Kong for the last 4 years. I say people just sort of perceive them as everything in Hong Kong is China, but hopefully that kind of gives you a bit of explanation as to the whys and the wheres.
Sure, absolutely. We have time for one last question, and I'll throw this out to the whole group. I think if there's anything that this focus on index selection has shown, is that while indexes are generally moving towards a common set of rules, and there are a lot of high-quality indexes out there, there certainly are differences even between broad-based beta-focused indexes. We've talked a lot about the emerging markets, but there are differences in size and style as well. My question is, is there ever any reason for investors to mix and match benchmarks, or should an investor decide to be, all FTSE or all MSCI or all Russell? And what are the risks and benefits of both sides of that equation? I can throw that out to FTSE first, and then to Joel.
But I'll perhaps have a go first, and then Jamie can follow me. But I guess, Matt, that most of our institutional clients are looking for benchmarks in many asset classes. We provide benchmarks which cover equities, real estate, infrastructure, currency, fixed income, commodities. We'd love our clients to exclusively use our indices across all those asset classes, but that isn't always the case. We do have clients who exclusively use FTSE benchmarks in the equities space, and there clearly are very significant benefits of that. No gaps, no overlaps, as it's often described. Each security is assigned to a single domicile. You have the use of a single sector or industry classification system. So the index series effectively is seamless, continuous, and consistent. But I would say that we've got many institutional clients who prefer to, for example, they'll adopt our EPNA REIT benchmark in real estate, but won't use all of our other benchmarks. And so, pragmatically, I think I'd come back to that, that story of choice. I think we'd love investors to use our benchmarks consistently, but there is choice out there. Jamie, is there anything else you want to add?
No, I think you've summarised that quite well, Jonathan. I don't know, say Joel has anything to comment on.
Yeah, I mean, I would just add that when you think about portfolio construction, which is ultimately what we're getting to here, it is important to understand where your exposures are. And as Jonathan mentioned, do you have overlaps? Do you have gaps? But that's in some ways irrespective of the different benchmarks that you have. I mean, think about having a benchmark and then having an active manager manage against that benchmark. It's not so much the benchmark that you have to worry about, it's the portfolio and where your exposures are, and that's true whether it's index or active. And what you're trying to do with the total portfolio, and sort of alluding to a comment earlier about individual mandate benchmarks, at the end of the day, it's the total portfolio that's providing the risk exposure and your risk return expectations, and that's ultimately what I think is the most important thing to focus on.
Absolutely. Well, with that, we've used up our full time. I'd like to thank our panelists, Joel, Jamie, and Jonathan. I think we covered a lot of great ground. I would like to thank the audience for attending. I would point out two things. First, for more information, you can visit any of the websites listed on this screen. I'd highlight that FTSE/Vanguard website where they've built information specifically about this switch. Beyond that, I'd like to invite all attendees to come hear our next webinar entitled Building a High Caliber ETF Portfolio, How Institutional Investors Approach Index Selection, which has representatives from iShares and MSCI on it as well. So we give all parts of the story. I think this has been a phenomenal webinar. I think it's a phenomenally interesting development for the industry and for the firms involved. So thanks, everyone, for attending. I hope you enjoyed it, and have a good rest of your afternoon.
Thank you.